Today, we're going to dive into one of the most powerful yet misunderstood concepts in trading, the strategy of reversals. If you've ever been caught buying the top or selling the bottom, then this video is for you. Each and every trader wants a higher risk-to-reward ratio, which simply means bigger profits. A good way to achieve it is by trading the reversals. We all know that trading reversals is challenging, and it may lead to big losses at times. And that's why a lot of traders prefer not to trade the reversals. But if you use the correct strategy, it will help you out in spotting the tops and bottoms of the market. Like, in this chart, the market makes a reversal after this point. Now, what if we would have known this earlier? It would have led to immense profits. One of the most important skills that a trader can acquire is the ability to reliably determine when a reversal will succeed. And that is what today's video is all about. We will discuss all these things in this video. This video covers all the topics from basics to an advanced strategy, so make sure to not skip any part. And believe me, this strategy will really change the way you trade the reversals. So, make sure to stick around the video. Now, before we move on into the video, if you are interested in the content like this, then like this video and don't forget to subscribe to our channel along with clicking on this bell icon. Now let's move on into the video. Let us first look at some of the basics before learning about the strategy, as the basics will give you out a better understanding and therefore, it will be easier for you to understand. First, let's begin with what are reversals. The reversals are those areas or levels from which the market changes its ongoing trend and starts a new one. The reversal trading means to identify the key levels or the points from where an asset's price direction changes. The ongoing trend can be uptrend or downtrend as well. Now let's see when does a reversal occur. There is not a specific time of a reversal occurring into the market. After analyzing hundreds of reversals in the market, we finally knew that most of the reversals occur after market goes into the ranging phase of the market, and that too. It usually makes a support and resistance zone, then breaks it, and then by grabbing the liquidity, the market makes a reversal. Most of the times, the price makes a pause before making a reversal, and thus, we must learn about the pause. So, what does a pause mean? Let's learn about it in brief. When the market stops going into the direction of current trend, it is said that the price has made a pause in the current trend. The pause can be in form of sideways too. A lot of traders consider the pause and the pullback same, but they are not the same. That's because the pause can result into a reversal also in the future. But don't consider every pause as a reversal. And therefore, you should be careful while initiating a trade during the pauses in the trend. Let's take a look at a real-time chart example where a pause occurs. Here we have the early chart of goals. You can see that higher highs and higher lows are forming, which clearly indicates an uptrend. So naturally, we'll be looking for buying opportunities. However, notice how the market is gradually weakening. This is evident because it's making smaller impulse moves. Eventually, it enters a consolidation phase, and this phase is crucial. Why is it so important? Because many traders jump into a buy trade just by seeing the breakout of a single candle, often without proper confirmation. We can see that happening in this example too. At this point, the market dipped slightly below the previous low. And since it was a large bearish candle, many traders were trapped into selling at the worst possible time. Traders got trapped because they mistook it for a reversal. Now comes the big question. How do we know if it's an actual reversal or just a normal pullback? The answer is simple. Let the market reveal more information. Wait for a few more candles to form and observe whether the price starts moving in the opposite direction or continues in the same direction. Here's something very important to remember when trading breakouts. The candle that forms after the breakout candle is what matters the most. This is because breakout candles are often highly manipulated. This thing can be clearly witnessed in this example. Here, the market is moving within a range. So, we're waiting for either a bullish or bearish breakout. The market starts moving downward and eventually makes a bearish break, but right after that, we see bullish candles forming. This is where most traders get confused, and for good reason.
Why?
Because this could be a fake breakout, and the market might simply continue moving sideways within the range. In fact, we've seen this happen before. Look at this earlier bearish break. After this break, the price re-entered the range. It first made a big bearish candle, and by seeing it, a lot of sell orders would have been taken at this level. But immediately after that, it made a bullish candle and continued being in a range. This is the reason behind this point being a crucial level. Now let's get back into the current scenario. The market has made multiple bullish candles with bigger bodies. And therefore, we can conclude that this is a fake breakout, and the market may re-enter the range, or it might make a bullish break. We can enter in a trade with 1:1 risk to reward ratio. The target of it will be kept at this support level and the stop loss near this resistance zone. The market went above, giving us out bigger profits. Therefore, we suggest you not to take any decision until the market gives out the confirmation with at least 2-3 candles. This trick is highly useful to breakout traders as well as to the intraday traders too. This is the advice that we usually give to all the traders, that you should never be in a hurry while making a trade. The confirmation is what you should wait for. Now that you've mastered the basics of reversals, let's move on to the reversal trading strategy itself. We will use the confluences of price action and momentum to trade the reversals. So, here we have the chart of the market. We're seeing a pattern of increasingly strong impulsive moves, followed by minimal corrective activity with sign of bearish momentum. But now it is making smaller impulsive moves and bigger corrective moves. This indicates that the strength of the sellers is weakening. And as the strength is weakening, the buying pressure increases, which means the buyers are increasing. Also, it is now moving into the range as it is moving between these highs and lows. And as it is in a range, the possibilities of market reversing have also increased from this point. There's an essential thing you must understand about the market's behavior when it's in a range or near major key levels. In order to get a bigger risk-to-reward ratio, we must identify the liquidity grab during the range or during the support and resistance zones. You can see some of the examples of it. The liquidity grab happens, and then the market makes a big move. But here's a catch. The big move can be in either of the direction, and therefore, you must wait for a confirmation before entering into the trade. Like in this example, there's a bullish candle that went above this resistance zone, and then the market makes a liquidity grab. Again, in this example, first it went above the resistance zone a little, and then the liquidity grab happened. This led to this big bearish move. The liquidity grab forms a trap in which a lot of traders usually fall. This trap is essential as it helps in fulfilling the big orders of what we usually call smart money. Now here comes a big question: how to know when the liquidity grab would occur? The answer is nothing but the major key levels. So, the major key levels are the place where it occurs the most, and it can help us in earning huge profits. When liquidity grab is used in confluence with the major key levels, it gives out a splendid result to us, and that is what our strategy is all about. So, now let's come back to the strategy. The market has made a bearish break by going below the support zone, and below that, there's one more support zone. Let's see how the market reacts to this level. As the market has made two bullish candles with bigger bodies, this gives out us a confirmation that the market will continue going above further. And hence, let's go long from this candle. Remember to place the stop loss below the major key level, and the targets as per the profit you want, like 2x or 3x. We usually keep the risk-to-reward ratio at 1:3. But it's upon you, and it is highly based on your risk management. The price went above sharply, which helped us in earning huge profits from the market. There are 3 steps that you need to do as per the strategy. The first is to identify the major key levels. Second is to wait for the liquidity grab to occur. And the third and the final one is to wait for the market to give out a confirmation. This is all that you need to know. And once you learn this, you will earn out huge profits from the market. This brings us to the end of our today's video. But before we do so, if you liked our content, then like the video and be sure to subscribe our channel.